In this video, we're going to talk about Fibonacci retracement levels. Now, I know if a few of you have got a little bit more experience in this market and you've done a little bit of digging for yourselves, you may have come across the Fibonacci tool being used for extension levels as well. So to measure price projection points and things like that. But us personally, we don't use that. And we won't teach you anything that we personally wouldn't use in our day-to-day trading lives in any case. So we won't be covering the extension levels here. We'll just be talking about the Fibonacci retracement levels. So what are the Fibonacci retracements? Well, it's a very, very popular tool in the financial markets. The Fibonacci numbers were first discovered a long time ago by an Italian mathematician named Leonardo Fibonacci. I think his name initially was Leonardo da Pisa or whatever, but that's not important. But ultimately, the important thing here is that this mathematician found that there was sort of like a golden ratio. So if you measure like your arm to your hand and different parts of your body, and there's a number of different things in this world and they all sort of conform to this golden ratio. So people decided that maybe this could be applied to the financial markets as well. And what they started to do was measure retracements of moves, and they found that a lot of the moves fell within that particular golden ratio. Now, over a period of time, there have been other numbers thrown in there as well. So for example, the 50 and the 78.6% level, they aren't essentially Fibonacci levels, but they're retracement levels. Again, the markets have found that the price is sort of adhered to these particular levels. So they've been thrown in there too. So what you actually have, even though you call it the Fibonacci tool, ultimately it's an amalgamation of a number of different numbers. But the most important thing to remember from all of this is that actually these are levels that price does actually respect. So if you look at any particular retracement, you will see that price tends to conform to these particular levels here that we're about to talk about in these videos. And that's why it's important. Remember, we aren't looking for any magic system or any magic indicator. What we're looking to do with our trading is ultimately trade what the rest of the market sees. That's what's going to make our trading that's what's going to give us high probability entries. Okay, it's not going to be those magic formulas that no one else knows about. It's going to be trading those levels that the rest of the market pay attention to. So the key levels are the 38.2, the 50, the 61.8 and the 78.6 retracement level. Now, the thing to remember about this is it can be quite subjective because you have to draw in these particular retracements yourself. So you need to pick where the best point is to start the tool from and where the best point is to end it. And we'll show you how to do that in this video, but you just have to remember that it is a little bit subjective. There's different people do it in various different ways. And for that reason, we prefer not to use them in isolation. So we wouldn't ever just trade a Fibonacci bounce just because that number's there. We'd only trade it if it comes in conjunction with another form of support and resistance. So maybe one of our moving averages, maybe one of our horizontal lines of support and resistance, or possibly a trend line. But you get the point. We wouldn't ever just use it in isolation on its own. So how do you draw these things? Well, they need to be drawn from the most recent swing points. Okay, so you're drawing it from the swing high to the swing low in a downtrend, or the swing low to the swing high in an uptrend. You're looking to ultimately see when the market starts to pull back, when the market starts to take profit, where is there going to be a level that they could possibly look to turn the price around and continue in the direction of the dominant trend. And that's all we're looking to do here. So remember that we love our support and resistance, right? Well, this is just another tool, another form of support and resistance. So how do we use the Fibonacci retracement levels? Well, with any other form of support and resistance, we use them for both entries and exits. Although we mainly focus on them using them for entries, as I said to you earlier on in the video. We don't really use the Fibonacci extensions for exits or profit targets or anything like that. We primarily use them for our entries. So we look at the retracement levels. Where does the price pull back to, and where would it be logical for the price to turn around and continue in the direction of the trend? Okay, so we look at the Fibonacci retracement levels for reversal opportunities. And obviously they're stronger if they coincide with other levels of support and resistance. We don't use them in isolation. It wouldn't make any sense to use them in isolation because, as I said, they can be quite subjective. So we use them in conjunction with other forms of support and resistance. And if we get a confluence of levels together, that just backs up our trading idea. That makes it a higher probability trade. Now remember, there isn't any one trade in the world that's ever going to be 100% successful. All we're looking to do is we're detectives. We are building the clues and we're building a case for our particular trade. And the more evidence that we can collect to support our particular case, the stronger it's going to be and the higher probability it's going to be. So this is just another one of those tools that we're going to use in our trading arsenal, if you like. So here we have a few examples of how we use them. Now remember, I said we measure the most recent swing high to the most recent swing low, and I've used these examples here just to illustrate how the price reacts with these particular levels, especially when they come in conjunction with a previous level of support becomes resistance, or previous level of resistance becomes support. So let's imagine that you can't see the price from here. Okay, so let's block this bit of the price out of the way. And what we have is this big down move here. The market then starts to retrace a little bit up. What we would then do is we'd get our Fibonacci tool. We'd start at the top here at this swing high. We'd then bring it down and drag it down to the bottom of this swing low here. And then these lines here that you can see on your screen would be created automatically. And what we would be looking for is we'd be looking for the price to turn around at one of the retracement levels. But as I said, we like to see it in conjunction with a level of support and resistance as well. So we would be looking at not necessarily the 38.2, we'd probably be more interested in the 50% level here, because that also coincides with this particular support level here on the left. So we've got this previous level of support, which could become resistance in conjunction with the 50% retracement level. That just makes for a much stronger trade opportunity. And look at what the price does immediately after that. It just sails away, sells off completely, and gives you a very, very nice trade there. In an uptrend, how would you do it? So we've got an uptrend here. It's not quite as clean as the previous one, but I've done that on purpose because all trade setups aren't always going to be as clean as the one that I just showed you. So we start here at the bottom. So we've had a bit of an up move there. The market starts to pull back. We would then draw in our Fibonacci retracement level. So we'd got the start at the bottom here at the swing low, drag it up to the swing high there. And then we would draw a line in there at our level of previous level of resistance, which could also become support if we cast our minds to the left here. And you can see that that coincides between the 50 and the 61.8, but you've also got this level over here on the left as well, which just adds weight to that particular trade. Now, there's one thing that you need to remember in the FX market. I mentioned this in the basics video. Because there's no centralized exchange, there isn't going to be sort of any one source of truth for the price, right? There's going to be a number of different banks, a number of different brokers that are going to be giving their most competitive price. And for that reason, there may be a discrepancy of a few pips here and there from broker to broker, from platform to platform. So for that reason, we don't ever look at a level and look at it to be pip perfect. Instead, what we're looking for is we're looking for sort of like a trading zone, if you like. So, a price zone where we expect the price to turn around at. So the fact that this has kind of breached the 50% level and gone a little bit further than that previous level of resistance there isn't a problem to us. The fact that the price is turning around at that level shows to us and proves to us that the markets are paying attention to this level. And if the markets are paying attention to this level, then that's something that we want to do as well. Okay, so that wraps up the theory for this particular lesson here. What we will now do is we'll jump onto the charts and I'll show you how to draw these things in real time. So thank you very much for watching, and I'll see you in the next video.